Bank of Uganda is counting on its recent decision to buy gold from, among others, artisanal miners in the country to rein in the current account deficit, which stood at $4.4 billion, roughly 16 trillion Uganda shillings, in the past 12 months to April 2024. A current account deficit occurs when the total value of goods and services a country imports exceeds the total value of goods and services it exports. For Uganda, this has been steadily increasing in the recent past, partly driven by the country's investment in infrastructure and oil-related constructions, which heavily rely on imported items against relatively fewer exports. In its recently published report on the state of the economy, the central bank asserts that the move to buy gold locally will help it accumulate international reserves, and at the same time, it expects imports of raw gold to reduce, contributing to the reduction in the total imports, and in turn leading to a decrease in both trade deficit and the current account deficit. To finance the current account deficit, the central bank is also counting on foreign direct investment, which is projected to expand in the next 2 years and is expected to be the main source of funding to bridge this gap. In the medium term, the report says the trade deficit is expected to narrow, supposedly by the oil export revenues, starting in financial year 2025/26 and gradually rising in the years ahead. The first oil production is expected in 2025/26 and is expected to accelerate to 230,000 barrels per day in the outer years. Overall, the report paints an optimistic economic growth outlook of between 6 to 6.5% this financial year, but is however quick to add the threats to this projection, notably a weaker global economy, reduced export demand, high freight costs, unfavorable weather conditions, among others.